welcome back to another episode of the Isn't That Rich podcast. Today we have a guest on. It's our CFO with Farmers State Bank, Matt Businaro, and he has just gotten back from learning about all the new tax laws for 2024, and so we wanted to make sure that we got those out to you so you are well informed rolling into the new year. So this will be airing the first week of January. So welcome on, Matt. We're so glad you're here with us today.
Be here. Yeah, thank you.
Yeah.
I love to talk about taxes.
I mean, who doesn't? It's such a
So
dynamic,
fun.
Exciting topic.
Jill and I, we talk about them all the time. We're always like, where are they going?
Yeah.
Why did we do this?
Yeah.
So I'm excited to learn about the new laws,
Yeah.
new tax laws.
I will do what I can to help.
Because we don't want to go to prison, right?
Well, of course not.
Because you don't want to do something wrong on your taxes.
You know, statistically, very few people look good in orange. So
That's true.
It's best to avoid that.
Yes.
So Matt, we haven't been on the podcast yet. So can you tell us a little bit about yourself? Like, where'd you went to school? What do you do in your free time?
Absolutely.
How'd you get into working with Farmers State Bank in the first place?
Awesome. Yeah, I can absolutely do that. So I attended college at Southern Illinois University in Carbondale. Graduated in 99 with my bachelor's in accounting and sat for and passed the CPA exam in November of 2000. So that's business-wise for me. I was in public accounting for nearly 20 tax seasons with a local accounting firm, which is awesome. I won't share their name, but they are fabulous, and have nothing but great things to say about them and my time there. But in 2018, Charlie Holland, the CEO of Farmers State Bank, who is awesome as well, he and I have known each other since grade school and actually studied accounting together at SIU. He reached out to me and said, hey, we're growing. We need a CFO. Would you have any interest? And so I decided it would be a good opportunity to take the journey up with Farmers State Bank and been very, very happy that I have ever since then. It's been I'm very, very blessed to have worked at two wonderful places, and Farmers State Bank is just wonderful, great ownership, great environment. The employees are phenomenal, and we do great things for our communities, and it's wonderful to be a part of. So that's professional, personal. I've been married to my wife Tiffany for 23 years. We have two children, Ava, who's a junior at SEMO, and Justin, who is in 5th grade. And in my spare time, I'm usually doing stuff with them. Justin is very involved in theater, and so we spend a lot of time at plays. He's almost always in at least one play, if not two or three. And Ava don't see as much anymore as she's in Cape, but when she was in high school, we loved supporting her in the Marching Bulldogs. She was drum major for a few years, and we have a phenomenal band program in Harrisburg. So it's always awesome to travel and support them. Yeah, enjoy playing golf with friends. Also when I have the time, and that's pretty well.
And we played golf with you one time last year.
We had a blast.
We did.
I thought I saw you throw a golf club.
It was probably somebody else.
Yeah.
Don't think
It was Trevor Quinn Laird, right?
I don't have it. I don't
You
have
had
it.
a fabulous golf outfit on. I'll never forget it. So yes.
Yeah,
So
for sure.
fun.
For
Well,
sure.
we're glad to have you on today, Matt.
Good to be here.
Sounds like a CPA can be fun, so I'm excited to have you on to talk about taxes.
I try. Yeah.
Well, that's great. Let's get into it, right?
Okay.
So you just got back from learning all about the new tax laws for
Correct.
2024, and we're going to dive into that. So tell us a little about it. What's going on for the new year?
Well, I'm going to start with a disclaimer. The ultimate tax authority is the Internal Revenue Service and the state taxing bodies. So I am not a tax authority. You should not rely on my advice. However, if you hear anything today that you think would be beneficial to you, I would recommend that you reach out to your tax advisor, discuss with them, and let them help you make those decisions, because they know your individual tax situation better than I do, and so they are best to advise you on how to proceed. That being said, let's jump in and talk about it.
I love the disclaimer.
It's always about, everybody that's been on this podcast always says,
Consult your tax advisor.
Consult your tax advisor.
That's right.
Seems like that's like the top dog for all.
I feel like we need like a sinister sound effect, disclaimer,
Yeah.
something like
Luke,
that.
let's add a button. No, just kidding.
Disclaimer with an echo effect.
No, and we'll put the website too for the what you just mentioned in our show notes. That way, people can look up these new laws on their own time.
Yeah,
so
absolutely.
So let's get into it. What is it? What's going on? 2024.
Okay, excellent. So one of the big things that anybody who is in business has probably gotten, and I know I get in the peak of employee retention credit time, 10 emails a week from these ERC firms that are trying to get people to pay them to get employee retention credit. That was something that started during COVID. It was an incentive for employers to keep employees working. And like any good thing that comes along that's tax related, it ends up becoming ripe for fraud. The IRS has seen a ton of fraud with this. And so one of the big things they did this year, on September 14th, they put a moratorium on employee retention credit. So if you apply for ERC, it's the acronym for Employee Retention Credit, after September 14th, they are not basically doing anything with those claims anymore. Anybody that filed before then that hasn't got their money, they're kind of sitting on those. They're looking at those really, really hard. You probably won't get any of that money until spring of 2024. This is being recorded in December of 2023, so I will try to keep my time frames right here. Sorry about that.
No.
So if you get any emails from these, and I still get a few, it's slowed down quite a bit, but I still get some myself, and again, I'm sure most business owners still are. I pretty well just ignore, delete those. If you truly think that you are eligible for employee retention credit, talk to your CPA, but I'm sure your tax advisor, if they're any good at all, has already looked at this for you, with you, and if you were eligible for it, it's something that they already have done for you. So just caution, it's probably fraud, and would be a great idea to avoid those emails and just ignore them.
Just delete them. Because what was going on during COVID? So if you kept your employees employed throughout COVID, if you were an employer, you could apply for this tax credit.
And it's not just, that was obviously a big part of it, but not only that, you had to have, your income had to have been diminished. You had to be able to prove that you were negatively affected by COVID. A lot of the ERC firms are trying to talk about supply chain disruption, which actually is really, really hard to prove.
Yeah, I was going to say,
that
how
you're
do you
affected
prove
by
that?
But that's what they seem to hang their hat on. So they tell you, well, you didn't have a decrease in income, but this. Yeah, it's just very rarely are they successful. But they will want their money up front, so they'll get their money, they'll be gone, and you'll be left holding the bag ultimately when this is all done. So
okay, so if you're receiving any more of those emails right now, chances are it's fraud.
Yeah, the chances are good that they're trying to get some money off of you, and they'll be gone, and you'll be in trouble. And again, there's the moratorium. They're probably not going to reinstate it, I would imagine. So you're probably not going to get anything anyway.
Yeah.
What's like a legitimate email that it would come from? Is that a good question? You know what I'm saying?
My advice would be, if you truly think, if you didn't get ERC and you think you might be eligible for ERC, reach out to a tax advisor.
Consult your tax advisor.
Consult your tax advisor.
Yeah.
Don't respond to an email. That's just good practice anyway, right? If you get an email from somebody you don't know, you weren't expecting it, they're probably not up to any good. So just as a matter of course, I've got a real quick delete finger, and anything that I wasn't expecting,
Me too.
I'm not going to pay attention to. I also like a clean
Sometimes
inbox as well. So.
Sometimes I delete important emails.
Yeah. That does happen for me too. Unfortunately, get a little too quick.
Yeah.
So,
Yeah. Well, that's good to know. Great.
Yeah.
Very cool.
So so some of the other big things that are new right now are they're going to be more ERC notes here. I apologize. Are related to energy credits. So energy credits are not new, but what they have had for many, many years are you get a $500 credit for replacing windows, doors to make your home more energy efficient, right? But though that was like a $500 one-time credit. Once you've got it, you're done, right? And so they have updated things. Both sides of the political spectrum are big in favor of energy credits. The Democrats like it because they're very energy conscious. Republicans like it because it reduces your taxes, so everybody wins. So there's an annual credit now, and so you can do things this year and then turn around and do them again, different things next year, and kind of spread this out and benefit from improving your home's energy efficiency for multiple years. And so this is really, it's a good thing. Instead of it being like a $500 lifetime credit like it was in the past, it's a $1,200 per year credit.
Oh,
so
wow.
it's a much, much better benefit.
I want to break that down more. So a credit, I just don't know that much about taxes, but a credit, what does that look like? When you're doing your taxes, so that's a credit your account, or you bring your receipt that says I bought this new door that is going to seal my house.
Yeah. So
you know what I mean?
So kind of all of the above there.
Let's break down a credit.
So a credit is a dollar for dollar reduction of your tax liability, right? So if I do these energy efficient improvements and I qualify for the maximum $1,200 credit, let's say my taxes would have been $2,500. I apply that $1,200 credit. Now my tax liability is only $1,300.
So it essentially, if you do these things, it gives, so you're supposed to be paying in $2,500, like you just said, that would kind of lower that amount that you have to pay, correct?
Correct.
Okay.
So, and so if you've got taxes taken out of your W-2, off your paycheck, of course, then what that would translate to at the end of the day, if you've paid in $2,500 through withholding from your paycheck, that would translate into a $1,200 refund. I mean, that being said, these are what's called a non-refundable credit. So let's say you do the maximum $1,200, right? And your tax liability is only $1,000. You're only going to get a $1,000 credit. That $200 is not going to come back to you in the form of a refund. It's just going to offset your.
Good statement. And okay, so just so I'm making sure, do I have to spend $1,200?
Okay, well, yeah, let me go into some of the details of that.
Does my door need to be $1,200 to get the full $1,200?
Well, actually, it needs to be more than that. So it's 30% of the cost of your door. So to get, and the maximum credit of that $1,200, which is an aggregate max you can get, the most you can get for doors in any year is $500, and the max you can get is $250 per door. So you would have to buy an $833 or more door. Yeah. You'd have to do two of them to get the maximum $500 that you could get, right? So it's never really super simple, but it's not super complex, right? For the exterior windows and skylights, which another thing you can do, like an energy efficient skylight, which also would be pretty cool too to have a skylight, right? 30% of the cost of those and the maximum credit that you can allocate to windows and skylights is $600. So that would be $2,000 worth of windows or skylights in a certain year. So you kind of do the math on it. $2,000, that doesn't get me a lot of windows. So you can kind of replace sections of your windows over multiple years, and then you can spread that credit out, and you'll still get the full credit now. There's also insulation materials. It's 30%. They love 30%, right? There's no limit on insulation, so you can replace your insulation and get the 30%. But again, it's only up to $1,200, so it's not a lower limit like some of the other things. So yeah, $1,200. As long as you spend whatever 30% of $1,200 is, and you can get that. And then home energy audits, that's a new one. You get a $150 per year credit for home energy audits. And so that would be like if you have to spend at least $500 to get the $150 there.
Okay. So I guess I don't know what a home energy audit is. Do people come in and like an appraiser come in and check out your house and make sure it's running efficiently? Yeah,
and would offer suggestions. In 2024, which is when this is going to air, there is a requirement for you have to meet certain criteria to be, like right now in 2023, just about anybody that's in the HVAC or plumbing business could potentially do this for you and give you some recommendations. There's going to be stricter criteria. They'll have to pass an exam, kind of like the CPA exam, but specific to
Their trade, probably.
their trade, exactly, to be able to do this. I would recommend talk to your tax advisor, see if they know of folks who have this certification to do this for you if it's something you're interested in. But again, it's probably not a bad idea for that to be your starting point. See where you're maybe losing the most energy, whatever, and maybe target those areas first.
So you could pay for that audit, and then that audit is a tax credit. Is that
correct?
Am I saying
Part
that
of
right?
it.
That's it'd be part of that
So-
energy efficient tax credit. So if you spend at least $500, then you'll get the maximum $150 credit that could be applied to
Towards that.
that part. Yeah.
Okay.
So it's kind of like a tax write-off, but for personal. In the same way, like for business, you would buy something and then write it off.
Right.
But I know it's a credit. I know it's different.
Yeah,
so I'm not trying to
it's
confuse
like
everybody, but that's the way my brain works.
It's like a deduction on steroids. So a typical deduction that you might think of, like charitable contributions, which are an itemized deduction. You know, when you look at your itemized deductions, whatever that amount ends up being, you take that amount and multiply it times whatever your tax rate is, and that's the amount of tax benefit you get. So if you're in the 15% tax bracket, it'll benefit you 15% times whatever you spent. Tax credit is a dollar for dollar reduction in your taxes.
That's good. Okay. Good to know. So I'm thinking Ashley's building this new house. Does this same credit, if you're installing new windows and doors in a new home, is she going to qualify to get
Yeah.
something like this?
So that's an excellent question, and the answer to that would be, I believe, no. It's got to be improvements to an existing residence.
But I could still consult my tax advisor, of course, about it, right?
Absolutely. But then there would be some other things that you might potentially be eligible for, like if you pay sales tax for certain items, you might have a big sales tax deduction. If you pay more in sales tax this year because of things you're doing with your new residence,
Yeah, I feel like I
then
have.
you pay for your state income tax. Then you would, if you're able to itemize, then you could take that. So there are some things that you can get that. You may not be able to get this, but you can get other things.
So I should keep my receipts.
You should keep your receipts.
Absolutely.
Yeah.
Keep your receipts. We haven't talked about
I
that
have
enough.
a binder. Come on. I've got the house binder.
So we've got windows and doors, we've got insulation, and we've got this annual people come check out your, what did you call it? Audit.
Energy
An
audit.
Energy audit. Is there anything else that is under this?
Well,
or-
yes.
Okay, good.
So this is one category that's called qualified energy efficient improvements. These have to be to your primary residence. So some folks will have primary residence and a vacation home.
Right.
This will just be for the primary residence. There are some other categories that would be eligible for both your primary residence and a second home.
Okay, this is good because I made improvements on the river house. So this could qualify. Okay, tell me
credits.
more, Matt.
So, there's residential energy property expenditures, which could be natural gas, propane, or oil water heaters, central air conditioners, boilers, panel boards, circuits or feeders. I'm not sure exactly what that is. Somebody knows a little bit more about this than me could probably address that. Heat pumps, biomass stoves, biomass boilers, those sorts of things. So your more energy efficient heating and air type systems. The heat pumps, biomass stoves, and biomass boilers are actually a separate $2,000 credit.
Wow.
So if you do those things and then the $1,200 for the other things, you actually could get a maximum $3,200 credit.
That's really good. So I own a medical building. And it seems like everything goes wrong at the same time, right? So,
Sure, of course.
I had to replace a water heater and a HVAC unit all this year. So maybe I know with water heaters, there's a new thing within a water heater that makes it more energy efficient. So I wonder if that would count for it. I'd have to
Well,
consult my tax advisor.
Yes, but these are more for residences, not for commercial buildings.
Okay, so it's not so secondary wouldn't count for that. That's more of business. Okay.
Correct.
I wonder if businesses.
consult your tax advisor,
I wonder
Jill.
if
My goodness.
businesses get any kind of credit like that. That's pretty great.
Right. Well, and there are some energy things that businesses are eligible for, and we'll probably talk a little bit more. I think we're going to do another podcast.
Yes, we'll
about
get to
business.
that.
So we'll talk. I can't give you everything at once.
That's right.
It'd be too easy.
It'd be too fun.
Yeah. So as far as the energy credits go, that's a 30%. The residential clean energy credit, that $3,200 credit we talk about, that's a 30% credit of whatever you're putting in, right? And that's a 30% through 2032, and then in 2033 it drops to 26%. 2034 drops to 22%. After 2035 it goes away.
Okay.
Unless tax law gets changed, which, I mean, that happens.
So they're
all
hoping
the
we
time,
get
so.
really efficient and then it kind of drops off. Is that kind of what it sounds like?
Yeah. Then and of course, Congress is just reluctant to ever make anything permanent. But usually, good things get looked at, get extended, and so I would file this under a category of a good thing that everybody can feel good about. I'm not promising that it'll get extended, but I think there's a good chance that if people are still utilizing it when it gets closer to the end, they'll extend it. I would imagine.
Yeah.
So, other things for residential clean energy credit, solar property qualifies, solar water heating property, fuel cell property, small wind energy property. Those would be like your little wind turbines, geothermal, biomass fuel, battery storage. Those things qualify for that 30% credit. That's not going to be limited to $3,200. That's going to be 30% of the cost of those items. So, so there's also like the solar panels and some of those other things. That would be, your business would be eligible for those if you wanted to do those as well. And I'll talk a little bit more about the particulars of some of how that will work with depreciation, which of course individuals don't worry about depreciation. Businesses, though, on the other hand, depreciation is a very big deduction for them. And so there's some interplay there we'll talk about in a little bit.
Yeah. Well, wow. They want us to be more energy efficient for sure, which is all good.
Go green.
Yeah.
Another energy efficient thing, not related to your house, of course, but vehicles.
Vehicles.
Very, very popular thing.
I've been watching. So I got all these ads about this new, what was it, a Cadillac Escalade? And I was like, Tom, look at this thing. It is jacked up and it's beautiful. But tell me about these new energy efficient cars. Yeah. I'm considering one.
So they're definitely something to look at. The cost of the vehicle comes into play, though. If the vehicle is too expensive, you actually don't get the credit, and so it almost seems counterintuitive. It's like you can buy a moderate electric vehicle and we'll give you a credit, but if you buy a really, really nice electric vehicle, not so much. So this begins on 1/1 of 24, and you can apply the credit to the cost of the vehicle. So if you buy a vehicle that would qualify for this credit, it would actually reduce the price that you'd pay and have to finance or whatever at the dealership, rather than it being maybe a tax return credit. But if when you file your taxes at the end of the year, it turns out your tax liability isn't as high as the credit that you got. So let's say you get, the maximum credit is $7,500. And let's say your tax liability ends up being $5,000 when you file your taxes at the end of the year. So you got $7,500 knocked off the cost of the vehicle you bought. You're going to get to write Uncle Sam a check for $2,500 at the end of the year.
Okay, good to know.
So you kind of want to, when you go out and do this, you want to have a feel for what your tax liability usually looks like, so you don't end up having to write an unexpected check
to refund it.
Exactly.
Don't you have an electric car?
No, mine's gas, and not great gas mileage either, but it's awesome.
I was going to ask you if you did have an electric car. If you have to plug it in, and how does that affect your electrical bill?
And here's another thing. I just heard somebody had to replace their battery on their electric car, and it was like $25,000.
You're lying.
No, go look it up. Serious. Anyway.
Good to know. So if you've got an electric vehicle traded in before, while the battery's still good.
That's right.
Yeah. My wife actually has a hybrid Avalon, which also she really, really likes. So hopefully the battery's still good when it's time to move on to something else. So the clean energy credit's got to be for new vehicles. Could be for personal use, could be for business use, or both. The manufacturer's suggested retail price can't exceed $80,000.
$80,000
so
a
that's
ticket.
kind of the key number there.
Okay.
I'm sure that's
for actually that. Okay, so
it's a lot. It was super expensive.
let me retract. So for vans, SUVs, and pickups, it can't be more than $80,000. For a car, it can't be more than $55,000. So, So you got to find a $55,000 or less Tesla.
Yeah, I was going to say, how much are Teslas going for these days? Is it more or less than 55,000? I've never looked, but
I've not looked recently either. I'd say there's probably some that you could get for maybe less than 55,000. Okay. Otherwise,
what if it's used?
Excellent question.
Ooh.
Excellent question. So there is an energy credit for used vehicles as well.
Give an answer for everything.
Yeah. So let me find the dollar amount for that one.
And this is a question kind of playing off it. So it's $7,500. Is it the same for your van and SUV, or is it less for your car? You know what I mean? Is like your car and the SUV getting the same $7,500, or is the lower amount? You know, that's
probably not, Jill, because they're not going to make it that simple.
Yeah.
So, right, I'm sure they won't. It depends on the capacity of the battery. So there's a base credit of $2,500, and it can be up to $7,500 depending on the battery capacity. Okay. So consult the dealer, and they'll tell you what you're eligible for.
So that battery, I knew there was something about that battery. So, okay.
And so there's also credit eligible for the used vehicles as well. Again, you have to purchase it from a licensed dealer. So
you can't just buy off of Craigslist or like Facebook Marketplace, probably.
Correct. Okay. I guess unless your dealer uses that, which I guess some could. And the cost of the vehicle can't be more than $25,000 if it's used.
Okay. Good to know.
Yeah.
So consult your dealership and your tax advisor.
Yeah.
And your dad.
And your dad, for sure.
Yes. Not the barbershop. I mean, a lot of people go to the barbershop for tax advice. I wouldn't consult with the barbershop about this, but your dad would be fine.
Yeah,
absolutely. Other new things that we've got this year, there is a reduced state tax exclusion. So the estate and life gift lifetime exclusion in 2023
This is a big deal. Let's listen to this one. So this is the estate tax? No, say it again.
The estate tax exclusion. So there's a estate and gift lifetime exclusion. It's currently $12.92 million or $25.84 million for a married couple. But in 2026, it is scheduled to return to just $5 million.
Ooh, so it goes way down.
Is that good or bad?
That's bad.
It's bad.
So if you're inheriting a bunch of money from your family, you can only inherit this much without really getting a lot of it taken away.
Exactly.
Right?
So if there's an estate, and so you've got a wealthy individual that has a lot of property, business interests, things they own, right?
Yeah.
You have to own 26 million or more before you pay any estate tax. If you own less than that, then you don't have to pay any estate tax. And so in 2026, that will fall down to $5 million. So if you own more than $5 million worth of...
And think about how fast that adds up. I'm thinking about a couple of properties. I was looking at this piece of property the other day on Mille Lacs Lake where I grew up. It's for sale for $2 million and it's nothing. And so if you have two pieces of property that are, been in the family for how many years... Mm-hmm. I mean, to inherit that, you're going to have to pay how much in taxes? I mean, quite a bit.
Right. And when you bought it or your grandpa bought it or whatever, mm-hmm. They may have paid a very minimal amount of money, but, right. They're not making any more land. And so, the value of that just increases mm-hmm. Almost exponentially.
Yeah.
So
what if it's in a trust?
You still...
Trust...
should I consult my
You should
lawyer?
Consult your attorney and your tax advisor. Yes, they can give you the specifics because
they can give me the inside skinny on that one.
So many different types of trusts. That's another
mm-hmm.
topic for another time for someone who studied law.
So this is going from for 2024. No, this is 2026. It's going up.
It's going
down.
down. That's when it sunsets.
When it's lowering. So right now. As we speak, it's currently at
26 million. Is that what you
Correct.
said?
26 million. It's going down to 5 million.
Right.
Yeah.
Do you know why? What they say?
So
why'd they do this? What do they need?
The increases happened under the Trump administration. Of course, he was president in 2016. Mm-hmm. Seems like when there are big estate tax things, they generally have about a 10-year lifespan. Congress we'll give it to you for now, but where you want it to sunset and then 10 years from now, whoever is in office, let them kind of dictate how they want things to run. So depending on who's in the White House in 2026, it could get extended. It could
go up to like 30 million.
Yeah, I mean,
they can change it.
It'll be up to them to work with Congress to accomplish whatever their goal is.
Okay.
With that.
Yeah.
So it's important to give gifts now. There is an anti-clawback provision. So normally, if you give gifts, they can get pulled back into your estate, and so you could give gifts now. Theoretically, if this anti-clawback provision didn't exist, you could give gifts now, and trying to get the value of your estate lowered to where you're not taxable. And if those get clawed back, then the value of your estate goes back up again.
Yeah.
Even though you've got rid of that property, they're still going to tax you on it.
Right.
So there is an anti-clawback provision that prevents an estate from being taxed on taxpayer gifts made tax-free in earlier years. The benefit has to be completed. So you have to complete the gifts before the end of 2025 to take care of the higher exclusion. So it's very important to get all this done by the end of 2025, and they need to be completed gifts. So that means you don't retain an interest. So you don't say, I'm going to give you this piece of property, son, daughter, but I still maintain control over it, and I can get it back if a certain event happens that this comes back to me. No, it's got to be, it's yours. I have no right to it unless you want let me, stay at your house or whatever that I give you. But
I think about our family and kind of what we have a family farm. And so that was, as my grandpa passed, my grandmother is transferring down to the two brothers and all of that stuff. That's just, she, every 5 years they gift a little bit more and how to transfer it to the, she's still alive. But yeah, that was the goal. And that is to hopefully not have such a big tax at the end of the estate. Yeah.
And because we don't know what's going to happen between now and 2025, I think that needs to be the strategy. And then if something changes between now and 2026, you can, of course, revisit it. That's one thing about tax laws of all sorts is they're dynamic. We know what they are today. What they will be even a year from now, we don't actually know. And so that's why it's always good to have sit-downs like this to talk about here's what's new, here's how long we think they're going to last. So plan accordingly.
Yeah, absolutely.
With your tax advisor, of course.
Right. Well, good to know. Thank you, Matt.
Yeah. So another one of the new things is related to inherited IRAs. So there used to be a thing called a stretch IRA. That's no longer a thing. If you inherit an IRA and it's not from your spouse, then you have 10 years after you inherit the IRA to draw all of that out. So you have to pull it all, basically take distributions and pay tax on it within 10 years after the date that you inherit that. So that's
Has it originally been, you can have the IRA, say what you just said.
It says no stretch IRA. So
no, I know, but it's just your IRA is passed down to you, whatever we'll call it.
Yeah, so say I pass away, my husband's gone, and I want to give it to my sister or something, right?
Yes,
Right.
I'm saying, did it used to be just if I gave it to Jill, we're all doing all these scenarios. If I gave it to Jill, could Jill keep it till she died one day and now it's 10 years?
Well, so you would.
Or was there a different cap is I guess what I'm asking.
So, there were required minimum distribution rules. So if you were over 70 and a half, I think that now has increased. I think 73 now. 73 in 2023. That you had to take once you reached that age, you had to start taking it out over your life expectancy. And so now that's no longer a thing you are required to withdraw within 10 years after you inherit that. So the required minimum distribution age has also changed. It was 72 in 2022. Now it's 73 and will be that through 2032. In 2033, that will bump up to age 75. And so what's important about that, if you have not taken anything out of any IRA that you have or qualified retirement plan, what have you, you have to start taking a minimum amount every year. And basically what they do is they divide the value of your account by your life expectancy. The IRS has a chart of what your life expectancy is. They know how long you're going to live. It's pretty remarkable. So if you want to know how long you've got, you can look at that chart and you can find out.
You don't need to
Don't
go to
go
the
to your
fortune
doctor,
teller.
go to
Don't
the
go to the
IRS.
doctor. Go to the IRS.
Just go to the IRS. And whatever your life expectancy is, you divide the amount in your IRA by your life expectancy, and that's how much you have to take out that year. And then the next year you do it again. So yeah, that's kind of how that
good,
works.
Matt.
So,
Gosh.
and that's for traditional IRA. Now, Roth IRAs.
Yeah.
Several of us have Roth IRAs
That's
or
right.
Roth 401ks,
Right.
which are awesome, right? So the difference between a traditional and a Roth, traditional IRA or a traditional IRA or 401k, you get a deduction when you make a contribution to that. A Roth, you do not get a deduction. So these are after-tax dollars that you're putting in. When you draw that out, you don't pay any tax. So it's a beautiful thing. With those, you don't have to take required minimum distribution. You've already
With a
paid
Roth?
Hey.
right.
Because you've already paid taxes on it.
Yeah. So the whole purpose of the required minimum distribution is, hey, we gave you a deduction for contributing to this. Now we want to collect the tax that we
Pay
Didn't
us.
get.
Pay up.
pay up. Roth, you've already paid taxes on it, so we don't care.
You're free to go.
You're free to go.
But there is growth on that, so you don't have to pay the taxes on the growth.
Correct.
Oh.
Correct.
See, even with this thing, with the transfer or the
Yeah. So now the caveat on that is if it's in a Roth 401k, if your employer does a match,
yeah,
you don't get taxed on that match. So that's a lovely tax-free benefit.
right.
So it's almost like you consider your 401k being in two separate buckets. You've got the Roth 401k bucket, which is the money I put in, and you've got the employer match bucket that the employer put in that you never paid tax on. So whenever you draw money out, part of it's going to be Roth, part of it's going to be employer contributions. You will pay tax on that part
The
of it, but
employer
still
contributions.
paying tax on a third of what you take out is better than paying tax on 100%.
100%,
what
yeah.
you're taking out. So, or whatever that ends up working out to be. Another thing that's new is 529 plan rollovers. So
529 plan is for a college savings
Savings.
fund. We've learned
Correct.
that. Okay.
correct, yeah,
You didn't know we were so financially savvy, did you?
I'm impressed. I'm impressed. Yeah. So, of course, 529 plans are a wonderful way to save for college, tax-free for your kiddos. And of course, what you put into it plus any earnings on it grows tax-free. And as long as you take it out and use it for college expenses, eligible college expenses, then you never pay tax on any of that. It's great. So if you happen to get scholarships or just oversaved, and one thing you can do if you have a balance left after the beneficiary graduates, you can roll it to another eligible beneficiary. So if you've got two kids and one's done with school and there's got some left in their account, you can use that for the other kid. You could use it for yourself. If you wanted to go back and take some continuing education or
Oh, that's nice.
something, you could use it for yourself. Or you can roll it into a Roth IRA for the beneficiary.
That's
So,
right.
so that's new.
Up to a certain amount, though, you can't do the whole thing. Like, so say if you have $40,000 and you can't roll that whole thing into an IRA or a Roth IRA, right?
So there are, of course, as in everything, there's some hoops you have to jump through.
Okay.
You can't open up a 529 plan today and roll it into a Roth IRA tomorrow. So it has to have been there for 15 years.
Okay.
So this would be, you started really early saving for your kids' college. And then their income must be below the Roth IRA contribution maximum amount. It has to be moved straight from the 529 plan to a Roth IRA account. So it has to be a trustee to trustee distribution. You can't actually get a check and then put it into Roth IRA. It's got to be direct. The limitation is going to be $6,500 a year that you can move over from the 529 to the IRA. And then the most you could ever move over is $35,000.
Okay.
So there are hoops, but let's say everybody's done with school and you don't have any interest in going back and taking some classes yourself. This could be a way to still benefit your recent college grad.
Yeah, I mean, think about it. When you're in your 20s, you graduate college, what do we press on our kids? Save, save, save for your retirement because compound interest, right? So this is a way to give them a leg up, I guess, on that.
Yeah, and it's a Roth, so
Yeah.
it's going to be tax free to them. Not only what you put in from the 529, but the earnings as well. So
good.
everybody wins.
Yeah. So do it. I do think 529s are a good way to save.
Oh,
Absolutely.
Fantastic.
Yeah.
And then there's a couple of different varieties of 529 plans. There's the traditional savings account where you put money back and it grows, and then whatever's there is whatever's available for them to go to school wherever they choose to go. And then there's prepaid tuition plans, which are going to be state specific, and so you kind of, in that instance, you're kind of forcing your child to go to school.
Yeah, with prepaid
within the state.
Yeah.
So I mean, in Illinois, thankfully we do have several good options. So it's there are options, but if you do the prepaid tuition and they decide to go out of state, the benefit is not quite as good. I think it's still doable, but there's some hoops to go through. But the benefit of the prepaid tuition is if they are wanting to go to school in Illinois, they're paying for tomorrow's tuition at today's rates, which we all know, everything's
incrementally
going up. So,
yeah.
So that's a nice benefit.
For sure.
So, and that's pretty well all I have on new stuff. So hit me with some questions.
I mean, those were good. I think the energy thing, that was crazy learning about that. All the different credits that a homeowner for making improvements, which would give you motivation for making improvements on your home right now, buying new windows if you've been waiting, or doing those things to get some kind of credit for that. I think that's great.
And of course, the savings is not just the tax savings, but you're going to see the improvements in your energy bills as well. So
Right.
Even if there were no tax credit involved, it's still just a good idea to do it anyway. But the fact that there is a tax credit involved, it's kind of like, what are you waiting for?
Yeah.
After you've talked to your tax advisor, of course.
Yeah, for sure. So I've learned a lot in this episode. And if you were to leave our listeners with one piece of advice and it's not consult your tax advisor,
Oh, man, that's gonna make
what would you advise them to do moving into 2024?
I think it would be a good idea to do the energy audit, and of course, maybe by the time you're hearing this, it's too late to do something for 2023, but you're going to be early in the game in 2024, so you'll see that benefit. At a minimum, you're going to get a $150 credit if you pay $500, which I would imagine the cost of one of these is going to be magically at least $500, and just see where you've got room for improvement and make those sorts of changes. And I'm sure they can help you see, here's the cost, but here's what it's going to do. And here's how quickly then these improvements will pay off for you. So I think that's probably the biggest takeaway with the new laws that we've got coming into place in 23 and 24.
Yeah, because you'd hate to replace your front door, but it's your back window that's
What actually
letting your hot air out.
Right.
Right, exactly.
Well, good.
Good piece of advice. Yeah. That's very interesting.
Yeah, thanks for sharing
Matt.
that.
Taxes are fun.
If anybody would want to get in touch with you after this episode, just to kind of, run some things past you, or, talk to you about Farmer State Bank, where would they reach you?
Sure. So my office is in the Harrisburg branch, and my phone number is 252-2600, and so that's probably the best and easiest way to get a hold of me. I obviously do have email, but my name is not the easiest in the world to spell. If you've not ever seen it before, it's not a very common name. So call 252-2600 and ask for Matt, and they'll get to me. So.
Awesome. And if they were to want to look up these new tax laws themselves, where would they find them?
Sure. Well,
It's never as easy.
Google is always a cop-out, but you can definitely Google and see many good articles that are going to be written in professional journals or by accounting or legal firms that are experts in this, that are probably going to be the easiest and most digestible to take that information. You can always go to irs.gov, which is the IRS's website. You may get something that's written in what appears to be a foreign language, just because that's the way Congress speaks. Congressese is not...
Congressese.
It's a dialect that's not always the easiest understood. But that would be my recommendation, would be just if there's something you heard today that you want to know more about, that you think would be good, I would Google it and make sure that whatever you're reading is from something like a Forbes or like an accounting or legal firm, not necessarily like Joe's Tax Service.
Yeah, so legitimate
Joe,
tax.
if you're out there, I do apologize. I think you're a wonderful practitioner, but
I love it. Okay, sounds great. Thank you so much again, Matt, for being on today.
My pleasure.
I appreciate it. We'll see you next time.
So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. We'll see you next week.
See you next week.